After the best month of 2024 for Wall Street, is this as good as it gets? Welcome to Market Insight. I'm Elena Casas. The S&P 500 and the Dow closed out Friday at record highs, making November their best month for a year. Bonds were also up as the perception that Donald Trump's Treasury Secretary pick will be good for the market outweighed a slightly higher inflation number. Can stocks go much higher, though? To find out, I'm joined now by Matt Miskin of John Hancock Investment Management. Matt, hi! One analyst we spoke to earlier said the Trump trade would flame out by Inauguration Day as the impact of higher tariffs and a likely higher deficit became clear. What do you think?
Well, if you go back to the 2016 election, that is exactly what happened, actually. The first month or two followed this really nice small cap breadth in terms of market and improvement in sentiment. But then actually after basically January, it was all priced in. And then it came back to fundamentals. Global stocks did better. Earnings were the driver of stocks. So right now, earnings haven't been growing that much. They were down last year. They're up a little bit this year. They've basically been sideways for 2 years. In our view, if stocks really want to move higher from here, we're going to need better earnings growth. The street's already looking for 15% earnings growth next year. We think that's too high. We may need some time here to consolidate after such a good run.
Looking forward into 2025 then, what are you expecting from earnings? How close will they come to justifying those valuations?
So right now, again, the street's looking for 15%. We think it's probably mid-single digits, looking more like 5%. This is part of the valuation. So the forward PE ratio, which assumes a forward earnings estimate, is already embedded with 15% growth, and the PE ratio is 22 times. The highest in the last 30 years was the tech bubble, and that was 24 times. So we only have 10% more upside on valuation from here, and we've got some really strong earnings. We're trying to find value where we can in equities. We're going down in cap to mid caps. We're trying to use more of a value tilt in portfolios, because this is about as least value we found in global, in specifically U.S. equities, we've seen in maybe 20 years.
On the Fed front, Matt, we still largely expect a cut this month, but far fewer in 2025 than we were before Election Day, as Trump's policies are widely seen as inflationary. What might that mean for the market?
So right now, the Fed is probably going to take a step back and not be as conducive to markets and not cut as much as the markets think. But if the Fed holds here in December, that could actually cause a flattening of the curve. It could cause a bit less growth being priced into markets. It could make equities actually a little bit more volatile. So the Fed put that was here for much of the last couple of years may be coming off. The White House put is maybe coming on. But in our view, right now, we're kind of still in the midst of the honeymoon phase of the new administration coming to the U.S., but that's likely to turn in January into February into the middle of the year, where we're going to see what policies are. We're going to see what the fundamentals are. And it may not be as bright of a picture as we're seeing right now.
We do get jobs data out this week, of course, which will play into the balance of the Fed decision the following week. What are you expecting there?
Relatively low growth. So right now, the street is looking for about 200,000. That'd be a great number. The last couple of months haven't been that great, though. The 3-month moving average is more like, I'd say, 50,000 to 100,000 jobs. So it's been decelerating. It's hard. We're already basically at max employment. The job openings are turning lower, so there's less need for jobs. And you're just seeing a much tighter labor market. If the jobs market does decline, though, into 2025, the Fed's going to have to cut more. Bond yields are going to be a great place to be in bonds in general, and equities likely see some downside in valuations. For now, we're in this nice middle spot in terms of the job market, but if the pendulum swings to the weaker side, expect bonds to have a nice year into 2025.
You sound quite cautious there, Matt, and you said value has become hard to find. So how can you position from here?
Yeah, high quality income continues to be an attractive place for us. So we're looking at about a 5% yield in investment grade corporates, mortgage-backed securities. And we're looking to lock that in for the next 5 to 7 years. So if we're doing 5% there, That's pretty compelling return stream in our view on a risk adjusted basis. On the equity side, you got to try to find value. Large cap US is expensive. Small cap's not as high quality. So we're in the middle part of the market. We are looking abroad for certain opportunities in Europe, Japan, and emerging markets. But what we're just trying to do is use that value tilt in equities and get some nice high quality income while we pay to wait in the bond market.
Matt Miskin of John Hancock Investment Management. Thank you so much for that analysis. And that's your market insight. You can watch more videos on Reuters.com.